everyone. Welcome back to another show of Reinventing Finance with Tom and I. Today, we are very pleased to have yet another very insightful guest, Min. Welcome aboard. And why don't you introduce yourself? I'm sure you can do it so much better than I ever could.
Yeah, so thank you for having me here. My name is Min. I have created a company called Mandalore Partners, and I'm an asset builder, especially in the Insurtech world. My background is basically very simple. For the past 30 years, I work mainly in corporate venture in all kind of forms. One half of the work in the media business with Bertelsmann in the time where Napster was hot. Second part is with Nokia Ventures. It's Nokia, one of the first investors in PayPal, for example. And then for the past 10 years, I was mainly in the Insurtech space. I launched the first fund of AXA Ventures called AXA Factory back in 2012. And I scaled it, and developed it. And I left a few years ago to launch Mandalore Partners. And today I work mainly with insurance companies to develop their fund business or their investment team. It's a kind of external corporate venture in the Insurtech world for insurance and asset managers.
So that was really, I don't think you minded that investment with Nokia Ventures and PayPal. I mean, I've just, even on the public market, PayPal was still a very good bet, a year ago, at least, I'm very happy with that performance. I just wanted to dig in. You've mentioned this kind of asset builder investor. What does that mean? How is that different to a VC?
So you have two business models that is used today. You have the VC model and you have the venture studio model. So let me go for the first model. The first model is a VC. So you have a fund, 10-year closed fund, and you invest a minority stakeholder in different startups you see to scale up. You take some board seats and so on. And you take a fees and a carry based on the value you generated. Then you aim at 5 to 10x, but for 5 years or 10 years. That's the first model. The second model is a venture studio. So you don't have a fund, you have some teams, and you kind of go and copy or go and create ideas with a mandate or without mandate. So you can be corporate centric, working for an insurance, or you can be entrepreneur centric, try to disrupt an industry. You create the company, you tend to have more share, like 40, 50, sometimes you have 60% of the share. You work with entrepreneur, you try to build it. I've done both cases and so on. But you start from zero. So the asset builder model, it's a mix of the two. You invest and then you build, but from a company. So instead of creating from scratch as a venture studio, you create, but from a certain company. So it's like if I take a crowdfunding platform, you invest in the platform, for example, and you build a crowdfunding fund on top of the platform. So if I take a simple example that everybody can understand, it's like you, on one hand, invest in Airbnb as a VC, and on the other hand, you create a real estate fund that go and buy studios to be put on Airbnb in order to find customer. So this is the work of the asset builder investor.
Okay, and actually, before, if you could name some of the partners you're working with, if you can share, just because you've mentioned, AXA is a pretty big brand name in insurance, especially in the European insurance space. From your personal experience, what were some things that positively, or that you've learned that, positively might have surprised you working with AXA? Any kind of 2 cents or experience that you can share that might be interesting and unexpected?
Well, I mean, in France, AXA, it's a big brand. It's actually
Germany also.
One of the brand in the insurance business before Allianz. Year after year, it's a key point. everybody in France would know AXA. It started as a mutual in Mons, so it started from one man who actually became the CEO and started to roll up a build-up strategy to buy different industry and different other mutuals and do merger and acquisition. So he did some private equity business here in his build-up business, and he changed the name to AXA, and you know where it is now. Within AXA, you have a lot of smart people coming from the top business schools and so on. And he has been always very forward thinking in the way they do things. I had the chance to meet a visionary guy called Nicolas Moreau. He was the CEO of AXA France and the board member of AXA Group. And he had in mind thinking of creating a tech fund in order to learn about technology and how to, to stop Google entering the insurance business kind of thing, more defensive role to start with. When I worked in a corporate venture or Nokia or other firms, we learned to do insight and foresight through a different framework. It's very simple. It's a framework that combines user, tech, and business trends. And when you see those trends converging, you know that the disruption is coming, and therefore you need to do something about it. Otherwise, you get eaten by somebody outside the industry. So, for example, to illustrate my thinking, when I was in Bertelsmann, we look at Napster, and then user wanted to listen to online music and a single CD. You have technology that can do peer-to-peer, like Napster. So technology trend merging with user trend creates a huge use case. And then there was no business case because it couldn't scale and got a loose out from labels. But then Apple came with the $1 song, and you were the creation with of the Spotify, Deezer, iTunes of the world. So you have a user need, a business need, and a technology need converging. You have a disruption coming from outside the industry, and therefore you have to worry. So I used the same framework, and I told Nicolas, you have user wanted to have services, from insurance and not more services going forward. You have basically insurance would like to create a new business model, becoming more partners and not simply payers. And therefore, surely new technology will come ahead to disrupt that in the distribution side or in the product side. And therefore, the disruption will come in, we call that, Insurtech. And if you want, you can, structure a small fund to take care of those things. And he did. And that's why the story started.
Awesome. No, and I'm kind of looking at the strategy as it is right now, that they seem to hold that North Star, from the outside in. It seems that they're very much about, not just auxiliary services, but that partnership and, kind of really putting their money where their mouth is. So that has been, I think they've been true to what you've just described and not just a strategy fad.
Yeah, of course, the venture was part of the bigger strategy. You have then the accelerator with Camet that was later on created. You have then the partners and so on and so forth. They all came from the same guy, Nicolas Moreau, that merged partners and so on and so forth. Now the whole entity is merged into something called Next Run and so on. And you can see that the people running those businesses they were connected one way to the other. To Nicolas Moreau, which was running to be the CEO of AXA Group. He's now the CEO of HSBC Global Asset Management because, as you know, Thomas Buberl became CEO of AXA a few years back.
Awesome. To kind of pick on a different thread that you've mentioned, and we've kind of compared and contrast. And thank you very much for VC and VC Studio and how Asset Builder is kind of a blend and hopefully the best of two worlds. As a founder, right? You have a corporate VC and you have a more financial traditional VC. In your own views, what do you think is the difference, or what would you recommend to an Insurtech in selecting one of the other? assuming that you have a choice?
So you have a, when you go to see a VC guy, he looks at you mainly based on the technology that you're building, and he has an idea how to sell it, or he looks mainly on metrics that you have. So the typical VC will look at your, if you are B2C, your cost of acquisition, your lifetime value, your unit economics. If the whole thing works well, then you put a ticket and and let's go. With corporate VC, it's a bit more complex because they have a strategic agenda. And sometimes if you fit a strategic agenda, even though it's not a good business case, they can invest. They can give you more insight on the pain point that you have to solve for them. So naturally, I am more on the second than the first, because the financial, CVC have strategic and strategic return on investment kind of thing, and financial return on investment, right? So the ROS, return on strategy, and the ROI, return on investment, which a VC would not have, right? And therefore you have to mix the two, and it's kind of hard to find the right domain, because strategy change every 3 years with a new team and a new CEO or new, whatever, political changes. And financial cycle are longer. Therefore, you might have two different strategic cycle before you have a financial cycle out in the early stage financing. And therefore, that's the disadvantages to work with CVC. But the advantages is they can give you a real insight to the pain point that no VC can come up with, because VC would not know. They work mainly with entrepreneur-centric. They are entrepreneur-centric. They are investment theme-centric. And therefore, if you want to be corporate-centric with an insight on the pen, CVC is a good path. In the past, CVC were more like the last one to go and look. But nowadays, some CVC are quite professional. They have good track record and so on. So I would not discount them in the scale of things.
May I just add a question to that? What were the strategic topics AXA found interesting? Because let's say that's already 10 years ago. What were at that point the topics they found interesting? Because if you are, let's say, on your LinkedIn profile, you just see certain topics, like I just saw med lanes, etc. So what liked AXA for strategic topics to dive into?
So the good thing about Nikolai, he has a lot of visionary people. One of them was Amélie Oudéa-Castéra. She's now the CEO of the French Federation of Tennis. So different story going forward. But she sees new cases coming up. So back 10 years ago, you didn't hear about, if we go 10 years ago, you learn about the sharing economy, right? The new Airbnb coming up and the new Uber coming up, and new use cases will be new to AXA, right? And insurance will look at historical data in order to price a premium. So new use cases, it's very difficult to cover because you don't know what's going on. So you have to model differently. You have to use technology to collect data in order to have a new pricing model, right, for your business. So when she sees that there was new use cases coming up, let's say in the sharing economy, then in order to make the framework work and to create a business on on top of the sharing economy, you have to collect data and you have to use technology kind of thing to be able to match the two. So my job was to search the right technology to help her understand new cases and new usage cases and so on and so forth. And once they have a good understanding of the cases, which they can do on their own, a new insight from the sourcing that I've done from the technology side, they can help to create new businesses and new and that was, for example, as a public example, the consequences of what they work mainly with BlaBlaCar, right? And the partnership with AXA and BlaBlaCar. It's not the work that I've done, it's the work that I've contributed to, right? I'm not the main orchestra, behind that. It's just to illustrate that in order to create something new, you need to have tech, user, and business converging.
Yeah, interesting. And
So
BlaBla is one of the most successful French stories, I would say.
It's one of the first unicorn, right? Since then you have a few others, but now Alan is a unicorn, but he was the oldest. I mean, back in that time, he was
one of the
certainly the
first.
first one or the second one. Yeah.
So maybe that's a good segue into Insurtech. So from your point of view, which Insurtech models do you like, which you don't like, and why?
So when I started at AXA, we cover about 3,000 startups in that space.
I call that pattern recognition. I think there must be some patterns to be recognized.
We found half of them was around distribution, right, which is the case. And so one half of them, and then 1/3 was on new products, and 50% was on claim and process, right? Since then, the things have changed and so on. But if we look at the same pattern, then obviously I like the distribution side because they have a lot of things to do and so on and so forth. But the evolution in Insurtech was first defensive with in the beginning. It became a bit more cooperative in the past few years because a lot of insurance realized that you have to partner them versus try to find them. And it's very rare that one of them will disrupt the whole business because it was more the unbundle of the insurance value chain and then trying to, improve certain part, right? And so on. And some of them have become more offensive in driving the insurtech space going forward now. One thing was about prevention. A lot of people are investing around prevention because you can prevent the case, you don't have to have any claims, so on and so forth. So that makes perfect logic. You can see now more and more insurance trying to provide capacity for insurtech. There's a trend called fintech goes insurtech. So a lot of neo bank are now becoming neo insurance. You can see that. And then in order to do that, a lot of digital broker, for example, are becoming MGAs, and you see a lot of people raising huge capital to be in that space. So now we see more and more insurance becoming more an offensive role by providing capacity or partnership and so on. And you can see more financing of VC combined with non-VC financing, right? In debt or in regulatory capital. So in specialty finance, we can see the rise of specialty finance in the insurance business on top of VC investments.
How would you define that? What do you mean? Is it like revenue-based lending, venture debt, or how would you define that or compare and contrast?
So I have a case of a digital broker trying to become an MGA. I think that can work everywhere, right? And let's say they raise 10, 20, 50 million, right, in order to do that. In the past, what I've seen is that I've seen a lot of people raising VC money, right? And of course, when you do that, you go to the guys who write a bigger check. So you would go to the Apex or to Sequoia, and so on and so forth. But then you have a capital that need to have a 5 or 10x going forward. They're putting a lot of pressure on the funders. They need to grow the company and raise even a bigger rounds going forward, right? So that's what I've seen in the past. Now what I've seen is a mix of financing. So let's say the 50 million one you want to raise, you may want to raise only 10 million from the VC, with which you have to probably to do the 10x, whatever, and so on. You can get the 40 million from other people that would be happy to lend you the money in a note or the basket bonds and so on, because they want to give you enough capital for your regulatory needs, but they are not VCs, right? And they're happy to place that money. So we see that mixed funding going forward now more and more. And this mixed funding can come from an insurance company, as for example, right? We know that, for example, Swiss Re is backing up a lot of fintech or insurtech, by providing capacity. That's one way to do it. Some of them are funding their captive and so on. That those are financing that are not done by VC, because VC don't have the expertise to create captive or to create capacity, as an underwriter.
No, I think there was an interesting statement by what's the guy who ran Score Ventures? The name, I forgot the name, but basically what he was saying is that, blending for MGAs or for, Fullstack insurers, blending reinsurance capacity and regulatory capital with an equity was actually a much better return profile due to the, subsidization of reinsurance capacity for quite a few. And I think Munich Re has been quite active and public in that space, but Swiss Re, as you've stated, has been, if you're kind of looking a little bit closer, you're seeing them, they're very active there as well. But with that, so if we were to take, do you have an opinion around under which conditions would you see from an investor point of view, okay, it makes sense for you to go for the full license versus the MGA route? Do you have an opinion on that, and where you would say, if that happens, I understand it makes sense that you'll get the, not just the capital requirements up, because you have a lot more operating expenses that doesn't give you a single customer if you're an insurance company.
It's funny you mentioned about Score, because Score had just changed this week the new CEO. So they were supposed to have a CEO from the external world, and they have appointed an internal CEO called named Laurent Rousseau. He's the ex-underwriter in PNC, executive board and so on and so forth. And he has been very keen on doing the Insurtech kind of space by writing checks to company directly going forward. So we see that trend from reinsurance people, right? But this trend can be done by other investors than reinsurance people. It could come from large capital going forward. I think that KKR has done to the credit teams big check for people to source for investments. You've seen a lot of people already that, and more also insurance that could also do that. So we see now that Insurtech can raise money from VCs, right, for their whatever scaling and so on and so forth, but they can raise debt and so on. So it depends with what kind of VC you're talking to. You have two types of VC, according to me, in the Insurtech space. You have the one that write, reasonable check, and they focus mainly on company that can improve part of the value chain. And you have plenty of them.
I like those.
And you have the VCs that are raising, big funds. They want to put 10 million tickets, and they have no choice to finance something like a neo insurance nowadays. And there's a lot of competition to do that. And the one behind Alan, for example, or the one behind other neo insurance going forward. And that's what it is. So you go back to the founders. If the founder has the capability to improve part of the value chain, or you want to do the whole thing, right? Hard to answer that question. I think I should return the question to what the ambition of the founders. And it's not so, in the past, when I was doing work at AXA, I've seen a lot of the second category, improvement of the value chain and so on. And when we see somebody that wanted to become a neo insurance, like a neo bank, it was too big a ticket, right? But now it's not too big a ticket, and now there's an appetite for that. So you will see more and more founders trying to run that, like neo banks, going. If you look at 5 years from now, and 5 years backwards. Sorry.
And I think that's really interesting, because I think if you are looking at least from a, if I don't think a neobank and a neo insurer have quite the same dynamics in terms of product engagement, etc. I think that the switching costs are different, but let's just say that there is an analogy. It's interesting, even if, you have number 26, Revolut, Nubank, but yet you see more and more neobanks just popping up everywhere, on more specific angles, because the hurdle rates on the infrastructure side, on the go-to-market, the playbook has kind of been written. And I think what we're seeing, at least in our discussions with insurers, is that it's so good for the enablers to see, it's cross-pollinating, to see people either as an MGA or Fullstack getting, taking a stab at a specific product distribution angle and showing that it can be done, because there's so many, as you've said, there's so many, smart, driven, entrepreneurial people within the insurance industry, but it's just sometimes crystallizing enough stakeholder momentum to kind of say, guys, do we just want to wait until we can do exactly the same thing, but we have brand access, etc. So I think it's actually cross-pollinating and continues to excite. I'd say.
Yeah, and so in that particular field, you see now the rise of new insurance, but they're mainly in P&C, right? So as the industry has evolved, people like me try to be more specialized. So for the past 2 years, I've been specialized more in innovation around life insurance versus P&C for health. And so now I'm looking for ways with other co-investors to fund and the rise of the new life insurance versus P&C. So that's one of my key scope this year.
And I think it's really interesting because I fully agree. I mean, there's been way more P&C business, and most life there is, you have Alan, but in Germany you have Otto Nova as a fully licensed health insurance. And what I find quite interesting is that Otto Nova has now they're doing white labeling, so they're basically using the La Parisienne / Wacom model. Mm-hmm. And they are powering the dental insurance. It's a simple dental, it's a simple health insurance product for Get Safe. But I think there is, as you can see, with that trend, especially in the B2B space, I think there's a very different group that needs to get really nervous. And it's not us enablers. I would say it is core system vendors, because what they're basically doing is outsourcing 3.0 to existing insurance companies through a reinsurance contract. And that is very interesting, because if you then can inject efficiencies that you do, the more you own the value chain without having to kind of, reinvigorate trust, because I think that's one of the big elements. So I think it's really interesting, and we are seeing way more models, as you can see in fintech, around, you might have a B2C proposition, but that doesn't mean that you don't do B2B2C, and you might even empower some of your competitors just to get traction on the platform if they have a certain access to a customer group that you would like to have. And I think that's really...
No, absolutely. I build on your points, but instead of doing just pure health and P&C, I try to concentrate on wealth and life insurance. So, for example, in China and on the platform, you have now the emergence of life insurance versus just and then they collect billions, right? So it is fairly possible that somebody out there has the idea to do the same. And we're now sourcing that kind of idea in order to fund it. And I've started to have some kind of small group deals of Insurtech specialist VCs that are willing to co-invest, and and that's what I'm trying to do in the next few months.
Oh, no, I think it's really exciting, and quite frankly, and I think we all see, the aggregation of certain topical ecosystems and wealth, or bank assurance, if you want to call it more traditionally, certainly one, and you see all types of insurance touch points and contextualization happening there. So I think it's going to be really, really interesting. I want
also just to add a question on that. Let's say in a sense, it also could be just a no-brainer, because I mean, life insurance has a totally different customer value lifetime, and also another connection to the client, so to say. If you compare it with let's say normal car insurance or something like that. So could you tell something more about this development in Asia of this life insurance? Because that's I mean, the whole discussion at the moment is on the one hand about neobanks putting insurance or cooperation with insurtechs and like Revolut and Cover and this kind of things. but you don't see that much in the whole media about new developments of reinventing life insurance.
No, but they are coming. Some are already there, and they're coming. You know, the Insurtech is behind fintech and
That's right.
probably ahead of asset management, right? So within Insurtech, I think PNC is ahead of or health is ahead of PNC, and PNC is ahead of life. I mean, you see very little innovation around life insurance, apart from distribution, right, and so on. So, but sooner or later, and as you understood, I work more on the early sign, right, because of my background. Now I see some sign, user, tech, and business converging into the disruption of life insurance. So you will see soon coming out neo life insurance out there, or embedded insurance, but not with PNC product, but with life insurance product. Going forward, we've been discussing that with Niklaus quite a lot, and then so that's coming, right? Not to enter any particular insight, and life insurance need to reinvent itself more than before, because now when you are a wealth manager or financial advisor, people with the COVID have more money to spare. Obviously the Euro fund is not returning the way it used to return, and therefore there's a lot of disruption coming up, right? Life insurance have to put more unit-linked securities in their offer. Before it was 20%, now it's gone from generally go to 60% minimum, right? And of course, because they have 60% of unit economics, then on the asset management side, you need actually to look for new asset classes, right? New ways to do it. So there's a whole revolution going forward from life in terms of distribution. So when you collect, to asset management, because you need to reinvent also the way you invest in order to improve the returns. So that is today my primary focus.
I thought I'd put it in the show notes, but I thought that was a really cool life insurance company, and what they've done, because they've tried to make it, and I think it's from the UK, instead of a fixed interest, what they've done within their pool of people, they've put a weekly lottery.
Oh, really?
And it's legal. So what they do is you basically set there's an average, but it excites. So you get this lottery ticket. So it actually forces you, it's like a elaborate gamification element. And it had massive, I'll put it in the show, like massive sign-up rates. Because with that element, and there was some probably min-max amount, but they meant this very abstract compound interest into something that people, for better or worse, really like, which is gambling and lottery. And I thought that was, I'll put it in the show notes, I thought that was quite an interesting engagement mechanism, which can kind of layer on top of it. Not sure it's going to fix the protection gap, though, in and of itself. But just also kind of conscious of time, I wanted to ask two more questions. One, if you're looking at the French Insurtech market, how does it compare and contrast to other markets? I don't know, UK, Germany, US, Asia, depending, you can take your pick. And would you agree that it seems to accelerate? It's probably one of the more active markets globally, I'd say.
Compared to the US or Japan, or okay.
So I think, the way, if I'm looking at, to me, Asia is a very unique market, or especially China is a very unique market because of the way that distribution works. And I think it's really hard to just say, I'm going to do what Zhong'an did and try to do it in Europe. But I think that the market dynamics in terms of how products are set, how distribution is set, I believe that continental Europe and the US are actually high level more comparable. I think the UK and Netherlands is a very different market because of regulation. But I would just, when you're looking from an insight into the French market, what could someone, let's say from Germany, Switzerland, UK, US, what could they learn from that? Is there something unique or specific happening in the French market?
So when you look at the insurance market, there's a lot of common points, right? Most insurance are, in the past lacking behind in terms of digitalization compared to other industry like bank. You have also obsolete IT for everybody because of acquisition and going forward and so on. So the only difference that you have country by country is the difference in regulation, because each country has a regulator, and so that's the main difference. So when it comes to the French market, it's a large market, behind digitalization for most of them. And I'm not talking about tier one, right? I mean, I'm talking about tier two. You have the AXA of the world and so on and so forth, but you have also in France, for example, I don't know, 400 mutual, and we don't see them right in the Insurtech world. They are really, behind and going so forth. And they don't have the manpower to create a CVC or venture and stuff like that. So for sure. But clearly, the difference is based on the regulation. So you can see differences based on the regulation going forward. So, for example, in France, when you have a life insurance and you give some funds as an asset buyer or owner to an asset seller, so an asset manager, you have a system of kickback or commission, which is not in other countries, right? So that's the specificity of the French market going forward. So so if you want to innovate in the French market, you need to know what's going on. So you have a certain MiFID II directive on sustainable finance, which is going for everybody, but it has a different implementation based on directive. So that's my only way to be different. So I tend to be specialized in the French market, as you know, also in Luxembourg. So because a lot of life insurance, in order to get distribution, putting some funds in Luxembourg. So Luxembourg and France is my two main purpose point, and that's what I can tell you.
Thanks. No, I think the knowing the interpretation of IDD, even though it's a pan-European regulation, I mean, the same for GDPR, there are local interpretations that whoever wants to comply, and it's not something, we'll fix it later. It's kind of, you got to get that right. I guess just as a kind of final thought, wanted to see whether you see something similar happening within, let's say, the mindset of insurance executives. So what we've seen, especially coalesce over the last 12 months, is kind of 4 interlocking developments or acceleration of developments. Number one, Corona, and let's leave out the customer for now. What Corona has done is they have all of these tied agents, brokers that traditionally have been very successfully selling insurance offline are now requesting for the first time actually digital tools from their insurance partners to engage. So for example, in Germany, you would have 200,000 independent agents, and all of a sudden you have 200,000 power users requesting digital tools, which they previously would not even enter the email address of their client in the CRM of the insurance company. Mm. 2, you have a tremendous, and I would say once in a lifetime opportunity to create market value. Embedded insurance is a big one. And just to give you an example, fresh from the press, Swiss Re has put a 5x multiple on gross written premiums in terms of market valuation. That's pretty feisty. 3rd, you see Alan, you see these Insurtechs gaining momentum, right? I think it's one thing to say, SME insurance, etc., and then you get another 200 million chunk into Next, and they're also signing up Amazon. So we see, and 4th, 5 years ago, you've mentioned AXA, they've implemented Guidewire, they're continuing to implement, and I would say, probably 50 million, 100 million later, I don't see a single insurance executive, even in a fully implemented Guidewire, saying, now I can go to market fast. So what we are seeing is, and they would not call it like that because FOMO is something I've learned in startup land, but there is a real fear of missing out with insurance executives who have P&L responsibility who say, listen, I have everything. I have the funding, I have the products, I have the access. The only thing holding me back was my internal stakeholders. Do you also see parts of that happening? Or is that, do I just have a select view and just, I'm in my echo chamber of change makers within the insurance industry?
No, for sure, for sure. One research that I've done last year is I took the 100 top trends or articles with the COVID impact, and I structured them into user, technology, and business trend to see what's going to happen, right? And what you say is that user, right, they are more aware of their policies and, you know, the risk and so on and so forth. And they are demanding digital tools to discuss with their agents. So obviously, so consequently, agents have no choice but to accelerate the technology around the digitization of customer service and so on and so on. It's all customer claim, right? So there was like the chief digital officer was the COVID-19 in order to accelerate that. And in order to do business with the COVID, for example, a lot of data were lost. Or the pattern were lost, and therefore, in order to build new data set, in order to price premiums, they have to use technology as well to do that. So they're being more forced to cooperate with startups out there to collect technology. So, example, in travel insurance, a lot of premium was done based on travel pattern, right? You have a travel pattern, and therefore you can price an insurance and you do statistically. But with the COVID, all the travel patterns were lost, and therefore there's no way to build new premium because there's no data to work on. And so therefore they have used technology to forecast new patterns. And therefore, and again, for that simple framework, user, technology, and business trend has helped us to actually see where are the area of disruption in order to look for investment or to for innovation. As you may know, I team up with Sabine van der Linden from Startup Bootcamp Insurtech to create Alchemy. So it's kind of research lab to develop innovation around what can happen for life insurance or P&C insurance, in fact, in the future.
Awesome. I have all my questions answered. Thank you so much. I don't know, Tom, anything to add before we wrap up?
Just for curiosity, because you have a very scientific or research-oriented approach, and you were very early, or you're always very early. And now it's the same for life insurance, etc. So you try to be, let's say, early on this cycles, and not to be the last one. What was your best investment decision in the past, which you can talk about, and where was there, for instance, a negative decision because perhaps you were too early, or because you also mentioned Napster, etc. So sometimes you see certain technical developments, or it also could be streaming and this kind, but then still it's a totally different topic to be successful as a company like Netflix. Although 25 years ago, everybody was saying, okay, in the end, we will stream movies. So what is the best investment, and what has been the, I wouldn't say the worst, but where perhaps your technical insights didn't connect to a good investment solution?
So for any VC, if you invest in 10 companies, whether you do with PhDs or whether you choose a monkey to pick up the investment as part of the committee, you have the same statistics, right? 5 will die, 3 will survive, and 1 or 2 will probably give you the 10x in order to come back. So the one that die, I have plenty, right? I invested in prevention around connected alcohol system to prevent you from taking the car and link to the mobile, and it didn't work out because it was too early and so on. Anyway, sold back to the founders and closed down. And so far in the portfolio from my early stage, the best one is a company probably called Flyer, which it's actually was selling predictive air tickets to user, and now they're selling a way to improve the booking and so on and so forth. But I think if you use the statistics, right, I mean, That's what I have, and it doesn't matter who you are. You always have the same statistics. So sometimes you get lucky, you get 100x, right? But that's basically my current track record.
Thank you.
Thank you so much. This was
thank you.
Really interesting, and probably one of the ones where we ran over the most, which usually is a good sign, at least in terms of content. Thank you so much for your time. Really appreciate it. And I can just say, really looking forward. I've got my first jab already. So really looking forward to seeing you, face to face on the circuit once we're through this, hopefully last and third wave.
Okay, thank you.
Thank you, Min.